The escalating Iran war, a closed Strait of Hormuz, more than 80 energy facilities across the Middle East have been damaged, and with 58% of Russia's domestic oil refining capacity severely crippled, the risk of another major energy price spike is rising fast. And while everyone panics, 6 stocks just turn into absolute steal deals. I'm not talking about Exxon or Shell. I'm talking about 6 smaller, fast-growing energy stocks most people have never heard of. I'll reveal all 6, their growth forecasts, valuations, their biggest risks, and which one offers the most explosive upside right now. The first one on the list is one of my favorite in terms of a risk-reward profile, and the stock is called Venture Global. Despite the Iran war, the stock is down 13% the last year. They are trading at a price to earnings of 15, which isn't expensive at all if you are expecting to grow your revenues 50% and your EPS 260%, and this growth will very likely continue for at least the coming 3 years. Venture Global is an American producer and exporter of low-cost US natural gas, with over 100 million tons per year of capacity in production, construction, or development. They started producing LNG in 2022 and are already one of the largest LNG exporters in the United States. That speed is almost unheard of in this industry. They own the whole chain: production, gas transport, their own ships, so they capture profit at every step. This is the killer stat. They have $336.5 billion of contracted future LNG sales spread over an average of 19.4 years. That's guaranteed future revenue signed on paper. New customers keep lining up. Total Energies and Vitol signed multi-year deals adding over 1 million tons per year starting in 2026. They closed an $8.6 billion financing for CP2 Phase 2, the largest standalone project financing ever completed, bringing total CP2 financing to $20.7 billion. By 2029, they expect 85 million tons per year online, and only about 60% of that is contracted so far, meaning huge room to sign even more deals. Roughly 20% of global LNG capacity has been offline in Qatar and Abu Dhabi. Less supply from competitors, more demand for American gas. Europe wants to get rid of Russian gas permanently, and Venture Global is becoming their go-to supplier. The negative point? The balance sheet is heavy, over $37 billion in long-term debt, and free cash flow is negative because they're spending over $3 billion per quarter on construction, but you're paying roughly 5.5 times forward earnings, and for a company that just doubled in size. Next up, we got an oil and gas producer that's growing 2 times faster, and it's called Infinity Natural Resources. This stock is down 15% last year, now trading at a PE ratio of only 4.2. The crazy thing is that they are forecasting to grow their revenues by a 120% in the next 12 months. And for their EPS, they are forecasting an increase of roughly 146%. This is clearly visible in the impressive revenue chart, but what makes them grow this fast? Infinity Natural Resources just made a company-changing $1.2 billion deal, growing 8 times faster than its industry, at 5.5 times earnings. The market hasn't woken up yet. That's exactly the kind of setup we look for. They drill for oil and natural gas in the Appalachian Basin, the eastern part of the United States, one of the cheapest places in the world to produce natural gas. The scale jump is massive. Their operated well count exploded from 154 to 395 wells, and their pipeline network grew to over 250 miles. In plain English, the company more than doubled overnight. And here's the part I love. The deal was funded with a $350 million strategic investment from Quantum and Carnelian, requiring no additional share issuance, so existing shareholders were barely diluted. Big private equity money literally paid to get in. Analysts expect 2026 revenue of roughly $649 million. That would be close to a doubling of the business. And insiders are loading up on shares. Between May and June, 4 different insiders bought basically $2 million worth of shares. They all did it with their own hard-earned money. This is always a bullish signal, and that is why I track that for all the stocks I own in my Discord, so I really recommend you to join the amazing community. Link is in the description. The third stock is expected to go from no revenue last quarter to forecasting $250 million in revenues starting from next quarter. The flip is also visible in their EPS chart. And this company is called Sable Offshore. This is a company that owns irreplaceable, fully built oil infrastructure off the richest coastline in America, backed by a federal national security order selling real barrels to Chevron. And after a brutal but necessary reset, the market is pricing it like it's still broken. Sable Offshore owns one giant asset, the Santa Ynez unit, 3 offshore platforms in federal waters off the California coast, plus onshore processing plants. They bought this entire system from ExxonMobil, and here's the crazy part. It had been completely shut down since May 2015, when a corroded pipeline ruptured and spilled oil near Santa Barbara. So for 10 years, billions of dollars of fully built oil infrastructure just sat there, doing nothing. Sable's entire bet was, fix the pipeline, win the legal battles, turn it back on. For years, California regulators blocked the restart at every turn. Then the federal government changed the game. Federal regulators issued a permit in December 2025, allowing Sable to restart, effectively overriding the delays from California state regulators. Sable was ordered to immediately resume oil transportation under a Defense Production Act order issued by the Energy Secretary in March 2026, meaning the US government literally commanded this oil to flow as a matter of national security. This is no longer a story stock. It's a real producer. Sable made its first oil sales to Chevron after restarting. All three platforms are coming back. Platform Harmony producing about 22,000 barrels per day, Platform Heritage restarting to bring the total above 30,000, and the Platform Hondo expected online by the end of Q2 2026, adding more than 10,000 barrels per day. On forward earnings, this is dirt cheap. The forward PE sits at roughly 1.8 times. The infrastructure advantage is unique. The pipeline has a stated capacity of 200,000 barrels per day, massive room to grow, and nobody can ever build a competing system off the California coast again. If the federal backing ever weakens, think of a different administration, then the whole thesis will be at risk. The next stock is the safest investment of them all and will benefit a lot from higher oil prices. The stock is called Vista Energy. This stock is up 40% in a year compared to the previous stocks that are down, but it still only trades at a PE ratio of 8, while they are forecasting very decent growth for the future. The only reason it's this cheap is the word Argentina. And if that fear keeps fading, this stock has serious room to run. Vista Energy is an oil and gas producer, and almost all of its production comes from one place, Vaca Muerta in Argentina, one of the biggest and best shale oil fields in the entire world, often compared to the famous Permian Basin in Texas. They have a simple business model: drill wells, pump oil at very low cost, and export most of it at global prices. Vista is one of the cheapest oil producers anywhere. They still make good money even when oil prices fall. In May 2026, Vista closed a $712 million acquisition of Equinor's Vaca Muerta assets, stakes in 2 premium blocks right next to their existing operations. This deal added about 240 new well locations to their drilling inventory. Basically years of extra growth bought in one move. And here's the big vision. After the Equinor deal, Vista is targeting 250,000 barrels per day by 2030. That would be roughly a 60% increase from today's level. Bonus tailwind. Under President Milei, Argentina has become much more market friendly with fewer restrictions on energy exports. A direct win for Vista. The forward PE is under 5. Let that sink in. Price like a business that's dying. On top of that, the company extended its share buyback plan with $150 million for 2026. Oil prices are a risk. If oil crashes, earnings will fall. That leverage works both ways. This is why the stock is cheap. Political change, currency chaos, or new export taxes could hurt. Milei has been great for Vista, but Argentina's history makes investors nervous. The next stock is a very safe and at the same time a high return stock for investors with a little bit longer time horizon. The stock is called NextDecade. NextDecade is building one of the largest LNG export terminals in America. Think of it as a giant machine that takes cheap American natural gas, freezes it into liquid, and ships it to countries in Europe and Asia that desperately need energy. The world wants more gas. America has the cheapest gas on the planet, and NextDecade sits right in the middle of that trade. The company is about to flip the switch from burning cash to generating revenue, and that moment is now less than a year away. The plant is being built by Bechtel, one of the most experienced construction companies in the world, under fixed price contracts. That means cost overruns are largely Bechtel's problem, not NextDecade's. 5 production units are now fully funded and under construction, and they're not done. Production units 6 through 8 are in development, fully owned by NextDecade, and would add roughly 18 million tons of extra capacity. That's a path to roughly 48 million tons in total. For a perspective, that would make this one of the biggest LNG sites on Earth. This is the key point. NextDecade doesn't gamble on gas prices. Customers sign 20-year contracts to buy the LNG. The customer list reads Shell, Total Energies, Saudi Aramco, and EQT. When the biggest energy companies in the world commit for 20 years, that tells you the project is real. Right now, the market treats Next as a risky construction story with no revenue, but every month, that risk shrinks. Once Train 1 starts producing LNG in 2027, NextDecade transforms into an infrastructure company with contracted, predictable cash flows for 20 plus years, the kind of business that pension funds love. Meanwhile, AI data centers, European energy security, and Asian demand are all pushing global gas demand in one direction. The company currently has no revenue, big losses, and a lot of debt. Everything depends on execution. Construction delays or cost problems between now and 2027 would hurt. This is not a bet on higher gas prices for the short term, but a bet on a natural gas powerhouse in the future. The final stock with a 10x potential is already mentioned in this previous video, so if you want want to find out? I will see you over there.